Bo, the other day you and I were talking, and you said you were working on a deal and with the seller, and the seller's biggest reservation on going through with the deal was how in the world are they going to replace their cash flow?
Man, I deal with that all the time as a broker in this business. The number one thing I hear is, Bo, I'd sell, but where am I going to put my money? Or I can't sell because there's nowhere to put my money, right? And what I'm excited about on this video is that, you know, as a broker, we hear that all the time. Principals say that all the time, and we just take that answer because, yeah, it's probably hard to replace it, right? But in talking to you and going over some of this, what I've seen in the spreadsheets you've created and the analysis you've done is that most of these investors that say this, they've never actually gone to the point of putting it on Excel and doing the post-tax analysis and the post-expense analysis. And what I've seen on a lot of this stuff is the hurdle rate that you have to get past to meet the same cash flow is a lot lower than what a lot of these folks actually need to do.
Right. So instead of just accepting something as a truth, actually trying to proof it out.
Correct.
So when you look at selling, obviously you have transaction costs and there's a big tax component with that. And so, one of the things that you and I did was we sat down and said, hey, let's just make up a transaction and see how that pans out, right? So to keep everything super simple, we just said, okay, it's 100% owned, no debt, nothing like that, right? Long time ago, it cost $10 million. And, over time, you've been depreciating it, so you have a lower basis than that. And currently, the NOI is $1 million. And so we said, well, what if you sold that at a cap rate of 5.5%? So basically, you take the NOI times the cap rate and divide by the cap rate, and then you have a sales price. $18 million is the sales price. And we say, great. You have transaction costs there, and you have taxes. And so we think after all of those, you would net out $14 million in proceeds.
Okay,
right?
so you bought something a long time ago for $10 million. You got $1 million in NOI. Divided by a 5.5 cap rate, you got an $18 million sale price, right? You're saying after you pay all the transactional costs and the taxes, you're at $14 million. You're walking away with.
Right.
Okay.
So now I'm trying to say, okay, I take this $14 million, and how do I reinvest it and come up with the exact same amount of cash flow from that investment? Right. That's the question.
Right.
So what's interesting is when we did that, the cap rate on the new purchase is around 7%. So if you can exit at 5.5% and then turn
so that's if you didn't 1031, you bought something maybe after the identification period,
right?
Let down the road,
yep.
With the 14 million. Okay.
So then you say, okay, 7%. That's not impossible, but maybe that would be difficult in some areas. So what would happen if I did a like kind exchange? And so if you remove that tax component from there, all of a sudden, your proceeds are a lot higher. So in our example, taxes were about $3 million by the time you went through recapture and calculated all the depreciation. So $3 million of additional proceeds. Now you're sitting there with $17 million. And that cap rate is 5.9% in order to go. So you exit at 5.9 or exit at 5.5, and you only need to buy at 5.9 to get the exact same cash flow.
Right. So I was seeing those numbers come out, and I thought to myself, okay, so if you didn't do a 1031, but you still bought something, you got a 7%, let's call it a cap rate or a hurdle rate in order to meet that same cash flow, which, depending on the time, like we're in 2019, almost 2020, kind of hard to find something for a 7% cap rate that would be in the multifamily industry. But even if it's a 5.9%, with a 1031 exchange or 7% without a 1031 exchange, either way, it's a lot lower than I think a lot of folks think, because let's say that you could only find something for a 5.5 cap, right? So you're losing, say, 1.5 points to a 7% hurdle rate, but that may be worth it because you're going into, say, a 5.5% Starbucks or a Dollar General or whatever. That may be worth passing up the incredible management intensities of owning, 4 properties that sold for that price or 1 property that sold for that price, where the case may be.
Right.
And 5.9% cap rate, if you 1031, lowers that hurdle rate even more.
Right. So you're really going into what are all those other factors that you can't really put on a spreadsheet, right? Like ease of maintenance or, future appreciation value or,
the age of the investor. They may be, towards the end of their investment horizon. They're fine to give up a point or point and a half.
Yeah. So those are all those factors. So, what we did then was we developed a tool together. So it's on our website. We're going to have it free to download.
Yep.
And, but actually helps you walk through that. And the bigger question in all of this is, well, what happens when you add debt into the equation? You said, that was the first thing you said was, well, what about debt? And, it gets a lot more complicated. And that's why we developed this tool to help put in all these assumptions and help to model it out and really figure out, what does it take to sell and where does it put me economically and what does that all look like?